Hello everyone. Welcome to our today's advanced financial management class. My name is Dr. Joshua Aura. If you would want to connect with me in terms of revising advanced AFM, we have a WhatsApp group where we need to add you up. So you need to reach out to us through this number 0719 525,000. If you're doing AFM, we have a WhatsApp group that we recommend you to join. So today, I would want, ladies and gentlemen, us to talk about mergers and acquisitions. Mergers and acquisitions, and specifically, I would want us to do this particular question here of May 2017, question number 5A. But it will be very important for us to differentiate between these two terms, mergers and acquisitions. Ladies and gentlemen, remember, for mergers, two organizations come together, they lose their identities for a new company to be formed. So what have we said under mergers, ladies and gentlemen? Two or more companies combine. Two or more companies come together, they will get dissolved at the registrar of companies, and then a new firm, totally new firm, like now here C, will be born. Like C will be born. Like C will be born. So ladies and gentlemen, one thing that I would want you to understand, whenever we talk of mergers, we have our two companies coming together, they are losing their identities, and then we have a new company being formed. How about an acquisition? For an acquisition, if A takes over B, it is B that will disappear, and then we will have the entire arrangement ending up with A, which of course now will be superior, given that it has swallowed B. Like how Brookside was able to swallow Tuzo. If, for example, two companies like we have here, the cat and the rat, if these two, assuming they were to be companies, were to come together, trust you me, one of these will totally disappear. The rat will disappear. So then at the end of the day, we'll have a very well fed up cat, a very well fed up cat resulting there. So then this becomes a very good example of what is an acquisition. An acquisition. Ladies and gentlemen, what I want to do today is quite easy. I would want us to understand these concepts of maximum exchange ratio, concepts of premium, concepts of post-acquisition EPS, etc., etc., and to help us navigate through those waters is this particular question of May 20 of May, or rather November. Sorry, it's not November. It's not November. It is supposed to be May 2017, question number 5A. For those of you who have our books, RCM kits, you need to simply get them out and look for question number 5 under mergers and acquisitions. Question number 5 under mergers and acquisitions. Very good. So we are told there, A Limited is considering acquiring B Limited. The selected financial data for the two companies are as follows. They have given us annual sales, net income, ordinary shares outstanding, earnings per share, market price per share. Both companies are in the 30% tax bracket required. They want us to give them the maximum exchange ratio that A Limited should agree to if it expects no dilution in earnings per what? Per share. So number one, they want us to give them the maximum exchange ratio. Maximum exchange ratio is also known as, this is also known as non-diluting exchange ratio. Non-diluting exchange ratio. Ladies and gentlemen, whenever we have these acquisitions, chances are our EPS of this predator company, the company that is acquiring, that is making the acquisition, may have its EPS going down. And whenever EPS goes down, that becomes a dangerous ground in terms of poor performance of any entity. So most entities would want to safeguard their EPS. So we'd want that after acquisition, our EPS does not reduce. So that exchange ratio that guarantees the EPS of the predator company, also known as the parent company, not going down, is what we call the non-diluting exchange ratio. Non-diluting exchange ratio. And how do we get this non-diluting exchange ratio, which is also known as the maximum exchange ratio? Ladies and gentlemen, the maximum exchange ratio equals EPS of the targeted company, EPS of the targeted company, all over EPS of the predator, EPS of the predator company, EPS of the predator company, EPS of the predator company. EPS stands for earnings per share. Now, it will be very important for us to differentiate between the two firms that we have. Which one is the predator? Which one is the targeted company? How do we get to know that? At the very beginning there, they have told us, if you could take me straight away to the question, A Limited is considering acquiring B Limited. A Limited is considering acquiring B. So A is the acquirer, which is also known as the predator. So A is my predator, A is my predator, A is my predator, and the B, the one to be acquired, the acquiree, is the target company. The acquiree is the target company. And ladies and gentlemen, we are interested in their EPSs. The EPS of the predator, if you look at that particular table there, you'll be able to see that the earnings per share of company A, the predator, is 3.5, whereas B, the EPS of B, is 1.5. So having gotten these figures, come and plug them in here. So we have EPS of the targeted company is 1.5, all over EPS of the predator company, which is 3.5, and then straight away, you get your calculator, the kind of calculators that we recommend as RCM. They are known as FX OTR 570. That's a good calculator that is able to handle the simultaneous equations, quadratic equations, and many other functions very well. So once I have my calculator, of course, I'm sure it's on. Punch there, 1.5 divided by 3.5, say equals first. We are getting a decimal, but remember, for exchange ratios, we always prefer fractional parameters. So how do I change this to a fraction? It's quite easy. Somewhere here, you'll be able to see button ABC, AB over C, AB over C. After this calc, AB over C. So this AB over C, I'm interested in its shift. So I'll talk of shift ABC. If I say shift ABC, I will end up getting 3 out of what here? 3 out of 7. I'll end up getting 3 out of what here? 7. 3 out of 7. So please, this is a particular value that I would want you to always remember, because I want to use another method to still derive this, 3 over 7. Meaning that at the end of the day, in terms of the exchange, the parent company will end up giving out 3 shares. For every 3 shares that the predator gives, it shall be receiving 7 shares in return. It shall be receiving 7 shares in return. Ladies and gentlemen, if that is okay, allow me to show you another method of getting this maximum exchange ratio. To get this maximum exchange ratio, method number 2. Method number 2. This maximum exchange ratio will be equal to the non-diluting offer price, the non-diluting offer price all over the MPS of the predator, all over the MPS of the predator. So this is what we shall be abbreviating as the NDOP. NDOP stands for non-diluting offer price. So ladies and gentlemen, our NDOP here, non-diluting offer price, how do we get this? To get the non-diluting offer price, we normally take the PE ratio. The PE ratio of the predator. The PE ratio of the predator times EPS of the target company, times EPS of the target company. PE ratio of the predator times EPS of the target company. Now, ladies and gentlemen, how do we get P over E ratio? To get P over E ratio, this is price over earnings. To get PE ratio, you take the MPS all over what here EPS. Then I can expand this slightly to look as follows. So we have MPS of predator, MPS of predator all over EPS, EPS of predator, EPS of predator, EPS of predator, EPS of predator times EPS of target company, EPS of target company. So look at this. To get PE ratio, it is MPS over EPS. So MPS of the predator all over EPS of the predator. Very nice. So what I need to do is to come and plug in the values. Go to that particular table. If you are able to see there on your screen, go to that particular table and read for us the MPS of the predator. MPS is market price per share of the predator. I can see that it's 40. Remember, A is our predator. So we have here 40 divided by the EPS again, the EPS of the same farm, EPS of the predator, which is 3.5. So 40 divided by 3.5, 40 divided by 3.5 times EPS of the targeted company. Just go to the earnings per share of the targeted company, which is B. So times 1.5. Give us an answer. Give us an answer. So we have here 40 divided by 3.5 times 1.5, which will give us a big number in form of decimals. But remember, because I want this parameter at the end of the day to give me some fractional exchange ratio, I'm better off writing this in form of a fraction. How do I do that? It is shift ABC. Shift ABC, I'm able to see my fractional parameter being 120 all over what here? All over 7. All over 7. Now, ladies and gentlemen, having gotten that, the next thing will now be to plug whatever figure we have gotten here into this formula for us to be able to get the maximum exchange ratio. So maximum exchange ratio will be non-diluting offer price. The non-diluting offer price is 120 out of 7 divided by the market price per share of the predator, which is company A. MPS of the predator is company A. MPS, you can see the market price of company A is 40. So you divide this by 40. So again, let us get our calculator. What do we have? We have 120 divided by 7. You divide again by 40. You say equals. Whatever we get, exchange ratio is always given in the form of a fraction. So whatever we get, we have shift there, ABC. You'll end up getting 3 out of what here? 3 out of 7. You'll end up getting 3 out of 7, which is the same answer we got using the other easier method. Now, ladies and gentlemen, having appreciated that fact, there is a figure that I would want you to remember. This 120 over 7, the non-diluting offer price. I would want you to remember that because I will be using this particular figure in my subsequent section. What do we have there? In my subsequent question, Roman 2, they want us to give them the total premium that the shareholders of B Limited would receive at the exchange ratio calculated in A1 above. So they want us to give them the premium. Ladies and gentlemen, shareholders of B are faced with 2 ways of disposing their shares. 2 ways of disposing their shares. So the shareholders of the targeted company, perhaps they are in a financial problem. At the end of the day, they have to dispose of their shares to raise money. So how do we get to dispose our shares? 2 ways. Either we go to our normal market, where we shall be able to get what we call market price per share, or in this case here, we have an offer price. So basically, we be acquired. If we are acquired, The acquisition price is what you guys gave me as 120 over 7. At this particular juncture, I would want to know what this 120 over 7 is. It is 17.143. It is 17.143, like that. So how about if these people were to go in the normal market and sell their shares? So we'll be able to get the market price per share of company B. 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 Market price per share of company B is 15. So you can see, ladies and gentlemen, without much explanation, that the shareholders of B are better off being acquired. I can see there is a profit to be made there. So what is the profit here? You'll come and subtract this and this. I'll end up getting 2.143 per share. So this is the premium per share. Then this begs for the question, how should I be able to remember the formula for getting the premium? For getting the premium, ladies and gentlemen, premium will always be equal to the offer price. The offer price minus MPS of the target. Offer price minus the MPS of the targeted company. The offer price is 17.143 minus MPS of the targeted company. MPS of the targeted company has been given. If you look at that table on your screen there, you'll be able to see the market price per share. The market price per share of company B, the targeted company, is 15. So 17.143 minus 15 will end up giving us 2.143. But remember, that is premium per what? That is premium for one share. Premium for one share. And yet we want total premium. So how do we get total premium? To get total premium, my friends, total premium, my friends, total premium, my friends, will be equal to the premium per share that you got, the premium per share. So we have here premium per share times nose, where nose is the number of ordinary shares. Nose, number of ordinary shares of the company that is being acquired. So the premium per share, we got a figure of 2.143 shillings per share times number of ordinary shares outstanding. If you look at the table there, you'll be able to see the number of ordinary shares of company B, not A, company B, which is what here, 2 million. So times 2 million, like that. So if you take here 2.143, we have here 2.143 times 2 million. That will end up giving us 4286,000. 4286 what here? Thousand Kenya shillings. And you are through with part 2. If you allow me, I'll go to part 3 very fast, where they want us to give them A Limited post-acquisition EPS if the two companies settle on a price of shillings 20 per share. So they want us to give them the post-acquisition EPS if the two companies settle on a price of shillings 20 per share. This is an examiner who is wishing me success. How do we get post-acquisition EPS? So to get post-acquisition EPS, to get post-acquisition, once we have acquired a company, then our total earnings will be earnings of the parent plus earnings of, in this case here, the targeted company. All over, we have number of ordinary shares of company 1 plus number of ordinary shares of company 2. But now remember, post-acquisition, company 2 will not be in existence. Company 2, in this case here, will have given out all its shares. And that is why the nose of company 2 must always be multiplied by what here? The exchange ratio. Please remember E1. E1, this represents total earnings of company 1. E2 represents total earnings of company 2. total earnings of company 2. Then we have these no's. This is number of ordinary shares of company 1, number of ordinary shares of company 2. And then we have ER, standing for exchange ratio. The normal exchange ratio, how do we get normal exchange ratio? We normally take the offer price all over MPS of the predator. All over MPS of the predator. Offer price all over MPS of the predator. Please, here in Roman 3, so many students were making use of the exchange ratios obtained above, which was very wrong. Here, this examiner had given us an offer price, and you can see the offer price which is being given there. The offer price which is being given there is 20. So A Limited's post-acquisition EPS, if the two companies settle on a price of shillings, what year? 20. The offer price there is 20. Therefore, this will be 20 all over. Please look at that table there. You'll be able to see that the MPS of the predator is 40. 40. So that gives us a half. And the moment I've got that, now I'll very comfortably, after I've gotten the exchange ratio as a half, I'll now very comfortably be able to plug in the figures here. So we have earnings of company 1. Earnings of company 1, don't pick the EPS. Here, so many students end up picking the EPS. Earnings of company 1 are given there on that table as net income. So the net income of A is 35. The net income of A is 35 plus the net income of B. The net income of B, which is 3. All over number of ordinary shares. Number of ordinary shares, what do we have, ladies and gentlemen? Number of ordinary shares of company A, ordinary shares outstanding there are 10. So we have here, I'm writing 10 plus number of ordinary shares of company 2. Company 2, number of ordinary shares outstanding are 2, multiplied by the exchange ratio that we got up there. So post-acquisition, just like post-marriage, the moment we enter into a serious marriage status, ladies and gentlemen, we expect earnings of the madam to be put together with earnings of what here, the husband, earnings of the husband. And if possible, that should happen in some joint account where it's only the husband who can access. Anyway, that's just a joke. So come here, this will be 38. So 38, you divide this by 2 times a half. Remember, body must multiply first. 2 times a half is 1. So 10 plus 1, that gives us what here? 11. So we have 38 all over 11. So we have here 38 divided by 11, giving us 3.45. So we have here 3.45. So we have here 3.45 like that. Shillings per what here? Per share. So the most important thing here is for you to appreciate the formula of post-acquisition what here? EPS. The formula of post-acquisition EPS. I hope that is clear. And if it's clear, let's go to Roman 4, the last one. Roman 4, the last one. They want us to A Limited's post-acquisition EPS if every 50 ordinary shares of B Limited were exchanged for 8% debenture of a par value of 1,000. So acquisition through a loan. Acquisition through a loan. What, ladies and gentlemen, we need to do very fast here, even without reasoning, is to come and provide the total loan. So total loan, they have told us that for every 50 shares we take, we shall be giving them a loan of 1,000 shillings. They have told us for 8% debenture, whose par value is 1,000. And then how many shares of theirs do we want to get? Remember, this is 100% acquisition. We want to get 100%. So we want to buy all the shares of B. Look at the number of shares of B which are outstanding. How many are they? We have 2 million shares. 2 million shares. So 2 million shares then will lead to how much in form of a loan? So in form of a loan, ladies and gentlemen, I will come and talk of 2 million. 2 million times the 1,000. divided by how many shares? 50. If you cross multiply, that is what you will end up getting. So then at the end of the day, what do we have here? 2 million times 1,000 divided by 50, which will end up giving us 40 million Kenya shillings to be advanced as a loan to this farm that you are trying to resuscitate. So 40 million. Of course, of concern to us, out of that 40 million, come and give the interest. The interest, ladies and gentlemen, they have given us the coupon rate. They have given us the coupon interest rate, which is 8%. So 8%. So we have here 8% of the 40 million. 8% of the 40 million. So we have 40 million times 0.08, which at the end of the day will give us 3.2 million, which will give us 3.2 million like that, 3.2 million. Now, having gotten that, our formula of getting the post-acquisition EPS is not lost on us. It's something that we have to keep on remembering. So we have our post-acquisition EPS being equal to earnings of company one, earnings of company one, earnings of company one, earnings of company one, plus earnings of company two. But now remember, this time around, given that this is a loan acquisition, we are not exchanging any shares, this being a loan acquisition, we expect the interest payable to reduce our total earnings. So minus the interest, but remember this interest must be after taxation. The interest must be after taxation. All over, we have nose of company one plus nose of company two multiplied by the exchange ratio. Multiplied by the exchange ratio. So please come and plug in the figures. Earnings of company one, these are earnings of the targeted company. What figure do we have here for the earnings of the target company? Earnings of the target company, we have 35. Plus earnings of company two. Earnings of company two, you can see there are 3. Earnings are the same as net income. And then we have the interest amount, which has to be the millions for conformity purposes, is 3.2. Multiply this with 0.7. Why 0.7? Because you can see just before required, they have given us the tax rate. They have given us the rate of taxation. The rate of tax, ladies and gentlemen, is 30%. So 1 minus 30% gives us 0.7. All of a number of ordinary shares of company one, number of ordinary shares of the predator, number of ordinary shares of the predator. How many are we talking about? 10. So we have 10 plus number of ordinary shares of company two, ladies and gentlemen, number of ordinary shares of company two. Number of ordinary shares of company two are 2 times the exchange ratio, which happens to be what, ladies and gentlemen? 0. Listen and listen to me very well. Whenever we are talking of an acquisition that is financed through issuance of a debenture or a loan instrument or preference shares, exchange ratio will always be equal to what here? Will always be equal to 0. Exchange ratio will always be equal to 0. Exchange ratio will always be equal to what here? To 0. Remember, exchange ratio is only applicable in situations where we are exchanging, two companies are exchanging between themselves ordinary shares. So A is giving ordinary shares, its own ordinary shares, and B is giving its own ordinary shares. But if the exchange is like we give you our ordinary shares and you give us, for example, a loan, or you give us preference shares or any other thing which is different from your ordinary shares, then the exchange ratio will always be 0. For me, for the sake of exams, anytime I see a loan being involved, and then number 2, anytime I see preference shares being involved, ladies and gentlemen, then automatically I know there the exchange ratio is what here? Is 0. I hope that is clear. And of course, if it's not clear, please get us on our WhatsApp group. And to get us in our WhatsApp group, this is the number 0719 525,000. 0719 525,000. So then, ladies and gentlemen, come and give us this parameter. Give us this parameter. So the parameter will be 35 plus 3 minus 3.2 times 0.7 equals divided by, of course, this will be 10, which will give me 3.576, which will give me 3.576 like that. Now, ladies and gentlemen, the moment we have that correctly, that now marks the end of this particular question. Please don't forget to buy our revision kits. For those students of ours who are taking our online classes, remember our offer. If you buy RCM's revision kit, like now this one for just 1,000 bob, we have a very great offer for you. You'll be able to attend 3 consecutive classes free of charge. You will not pay the 100 shillings per class. For how many classes? 3 classes. If you buy this book, Now, if that is clear, then I would want us to do another question. This other question that I would want us to do, ladies and gentlemen, is displayed there on your screen. It's November 2018, question number 4C. November 2018, question number 4C. November 2018, question number 4C. We are told here Chilulu Industries Limited is considering acquisition of Roca Corporation Limited in a share-for-share exchange. The financial data for the 2 companies are given below. You can see sales there. You can see net earnings, ordinary shares outstanding. You can see the ordinary share market price per share. You can see dividends per share. There is something that these people are hiding from us. There is no way I can ever get to do a mergers and acquisitions question without EPS. Additional information, Chilulu Limited is not willing to incur an initial dilution in its earnings per share. So meaning that they of course want you to calculate maximum exchange ratio later on. So Chilulu Limited will have to offer a minimum of 25% of Roca Limited's current share market price. So required, they want us to give them the relevant offer price range. So range must have minimum and maximum. So first of all, we calculate the maximum. So could you kindly give us the maximum offer price? The maximum offer price. So this maximum offer price is the same as our UNDOP. DOP is non-diluting offer price. DOP is non-diluting offer price. How do we get non-diluting offer price, my great students? We normally take the PE ratio of Predator. PE ratio of Predator times EPS. EPS of target company. EPS of target company times EPS of the target company times EPS of the target company. This is what we were able to break down to MPS of Predator, all over EPS of Predator, all over EPS of Predator times EPS of target company, EPS of the target company times EPS of the target company times EPS of the target company. So then first of all, we need to get the EPS of our companies. We don't have EPS. The normal EPS, ladies and gentlemen, we normally get the normal EPS by taking total earnings all over the nose. Total earnings all over the nose. Nose stands for number of ordinary shares. So then we have our 2 companies, company A, no, not company A, Chilu, and then we have Roca, Chilu and Roca. So Chilu, ladies and gentlemen, you can see the total earnings of Chilu. Total earnings, net earnings there. Net earnings of Chilu is 30. All over the number of ordinary shares of Chilu. Number of ordinary shares of Chilu which are outstanding are 6. So 30 divided by 6, that gives us 5. That gives us 5. From there, we go to ROCA. ROCA gives us earnings of ROCA. Earnings of ROCA, net earnings of ROCA, we can see 12. Net earnings of ROCA, we can see 12. Divide this by the number of ordinary shares of ROCA. Number of ordinary shares of ROCA. If you look at the ordinary shares outstanding of ROCA, we have 2 there. So 12 divided by 2, that gives us 6. That gives us 6. Now, ladies and gentlemen, the moment I get those parameters, now I'm at a very good position of giving you the NDOP, the non-diluting offer price, the maximum offer price. So the maximum offer price, the formula is given here. The formula is given here. It is MPS of the predator. So please look for the MPS of the predator in the question. MPS of the predator, they have given us on that table the ordinary share price. The MPS of the predator, Chilulu is the predator. Chilulu is the one that is considering the acquisition. So the MPS of the predator is 50. So we have here 50. All over the EPS of the predator, which is Chilu, EPS of Chilu is 5. Is 5 times, ladies and gentlemen, this formula here, EPS of the targeted company, EPS of ROCA, which happens to be what here? 6. 6 like that. So then these will end up giving us how much here? 60 is the maximum price, Kenya shillings. 60 is the maximum offer price. Is the maximum offer price. The non-diluting offer price. So remember, for this to be arranged, we must be having a minimum and what here? A maximum. We must be having a minimum and a maximum. We must be having a minimum and what here? A maximum. So what have they told us about minimum? So come and give us the minimum offer price. The minimum offer price they have told us there in this question in note number 1. Note number 1. Chilulu Limited is not willing to incur an initial that will not help us. Note number 2. Chilulu Limited, if you could take me to the question, note number 2. Note number 2. Chilulu Limited will have to offer a minimum of 25%. A minimum of 25% of ROCA's limited current share price, market price. So we have it is 25% of ROCA's MPS. So it will be 25% of ROCA's MPS. So I hope you're able to see the market price per share. ROCA's MPS is 40. Is 40. So 25% of 40, of course, that will give us what here? Will give us 10. And therefore, the offer range should be from the minimum to the highest, which is 60. So as we are negotiating with these people, if we don't want dilution of our earnings, we have to ensure that our offer price is well in between there. I hope that is clear. I hope that is clear. And if it's clear, allow us, ladies and gentlemen, to go to number 2. To go to number 2. Number 2, if ROCA Limited shareholders accept an offer by Chilulu Limited of shillings 40 per share in a share-for-share exchange, determine the post-merger EPS. Post-merger EPS is the same as post-acquisition EPS. So this is the same as post-acquisition EPS. This is the same as post-acquisition EPS, which I've taught you the formula. Once we get each other's spouses, post-acquisition, post-marriage, our earnings here should be combined earnings divided by nose 1 plus nose 2 multiplied by exchange ratio, multiplied by exchange ratio, multiplied by exchange ratio. Right? So in this particular case, what will be our exchange ratio? Remember, they have given us an offer price. And whenever we are given an offer price, this, of course, will be a good examiner, is a good examiner. Whenever the exchange ratio you have, whenever you're computing the exchange ratio and you have offer price, the formula is quite easy. Exchange ratio will be equal to the offer price all over the MPS of the predator, all over the MPS of the predator, all over the MPS of the predator. So what offer price have they agreed at? We are told in this particular Roman 2, if Roca Limited shareholders accept an offer by Chilulu Limited of shillings 40. So in this case here, the offer price is 40. All over MPS of Predator, the acquiring firm. The acquiring firm known as Chilulu has an MPS of 50. 50. So this will end up giving us 4 out of what here? 4 out of 5. This will end up giving us 4 out of 5. Will end up giving us 4 out of 5. Will end up giving us 4 out of 5. Will end up giving us 4 out of 5. You could show my board here. Will end up giving us 4 out of 5. What have we said about exchange ratio? It's offer price all over MPS of who? The predator. All over MPS of the predator. So this gives us 4 or 5, and I hope you've been able to copy up to there. So if that is agreeable, then come and plug in the other figures. So we are talking of the earnings of company 1. Earnings of company 1, the net earnings of company 1, ladies and gentlemen, which is the predator, I can see they are 30. So we have 30 plus earnings of company 2, net earnings of company 2, which are 12 there, all over nose 1. Nose 1, if you're able to see nose 1, number of ordinary shares, what do we have there? Ordinary shares outstanding. For Chilulu, I can see 6. For Roca, I can see 2. But remember, Roca's nose has to be multiplied by the exchange ratio that we got as 4 over what here? 4 over 5. But we got as 4 over 5. So we have here 30 plus 12. That is an easy one, which gives us 42. This gives us 42. This gives us 42. This gives us 42. All over 6 plus 2 times 4 divided by 5, which gives us 7 point what here? 6, like that. No. Let's see first. 2 times 4 divided by 5. Yes, plus 6. 7.6 is correct. So 42 divided by the answer, that will end up giving us 5.5263 Kenya shillings per what year? Per share. And then straight away now we go to Roman 3, which happens to be the last one. Roman 3, using the results obtained in C2 above, and assuming that Chilulu Limited's PE ratio will remain unchanged after the merger, determine the post-acquisition market price of a share. So remember, ladies and gentlemen, that generally our PE ratio equals who? Look at this. Our PE ratio equals what divided by what? It is MPS over EPS. So could you kindly make MPS the subject of the formula? Our MPS will be equal to PE ratio times EPS. PE ratio times what here? EPS times EPS. PE ratio times what here? EPS. What this examiner wants now is the MPS, market price per what? Per share. But which type of market price per share do they want us to do? Using the results obtained in C2 above, and assuming that Chilulu Limited's price earnings ratio will remain what here? Unchanged. Will remain unchanged after the merger. Determine the post-acquisition MPS. So they want us to give them the post-acquisition MPS. They want us to give them the post-acquisition MPS, which will be equal to our normal PE ratio, which will not keep on changing, of the predator, times, ladies and gentlemen, EPS, which also has to be now what here? Post-acquisition. So come here and they give us the PE ratio of the predator. The examiner has told us that the PE ratio of the predator will remain unchanged. PE ratio of Chilulu. You take the price over earnings. So for Chilulu, are you able to see the price? They have given us the MPS as 50. Chilulu, the MPS is 50. How about earnings per share? Earnings per share, ladies and gentlemen, for Chilulu. Earnings per share for Chilulu, we had obtained this figure somewhere. Earnings per share for Chilulu was 5 times the EPS post-acquisition, which is 5.5263, like that. So then at the end of the day, we'll end up getting, this is 10 times this will be 55.263 Kenya what year, Kenya shillings, which marks the end of this particular illustration question. Ladies and gentlemen, as you do these exercises, don't forget to buy our books. This book will cost you 1,000 Kenya shillings only. For the online students, once you buy such a book, you'll be able to enjoy our live classes, 3 of them, 3 live classes for free, consecutive live classes for free. What an offer. Otherwise, thank you very much, and continue marketing these programs to many more. And most importantly, ensure that they are part of our WhatsApp by them sending us a message to through this number, 0719 525 1000. We wish you well. Stay safe. COVID should not touch any of you. Thank you.